We're on. We're live.
Yeah, that's exactly right.
That is true.
I'm calling to order the joint meeting of the City of Salem Budget Committee and the Salem Urban Renewal Agency Budget Committee on Wednesday, January 21st, 2015. Would the city recorder do the roll call, please?
Mayor Peterson? Here. Member Bennett? Absent. Member Anderson? Absent. Member Nanke?
Here.
Member McCoy?
Here.
Member Dickey?
Here.
Member Benjamin?
Here.
Member Benars?
Here.
Member Lewis?
Here.
Member Berger?
Here.
Member Kylowite?
Here.
Member Bailey?
Here.
Member Moore Green?
Here.
Member Wildfang? Absent. Member Gonzalez? Absent. Member Clark?
Here.
Member Pruitt? Absent.
Thank you. Would you join me in the Pledge of Allegiance, please?
Pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
So this is our first budget meeting this calendar year. First off, I'd like to congratulate the mayor on her re-election
Oh, thank you very much.
and welcome our 4 new members.
yes.
Anderson, who's not here, McCoy, Benjamin, and Lewis. Welcome. I'm glad you're here. Can I have a motion for approval of the minutes for May 7th, 2015 of the City of Salem Urban Renewal Agency Budget Committee meeting, please?
So moved.
Right, motion by member Lanke, second by member Dickey. Any discussion? All right, all in favor of the motion say aye.
Aye.
All opposed say nay. Motion passes. Next on the agenda is Budget Officer Kelly Jacobs.
Thank you, Chair, and good evening, Budget Committee members. You have 2 items of handout materials in your packet this evening. Very quickly, one is your roster, and as you'll note, for the Citizen Budget Committee members, you have a common email address. We have changed the roster to provide you with a common email address, and we'll be receiving the emails then and then distributing them to you to make, we hope to make that easier for you. So we don't disclose your personal information, but we can send the email to you via your personal email information. So we thought this is an experiment and we'll see how it goes. And then the second item of handout materials is are the Budget Committee meeting procedures, or the committee procedures rather. So this is just for your reference, since this is the first meeting of the new calendar year. And if you have any questions about the procedures, please don't hesitate to ask anyone in the budget office. Thank you.
Kelly, while you're there, if I have, in theory, misplaced my logon, how can I retrieve that?
We can have our IT department assist you with that.
Okay, is there a number I can call?
Actually,
Okay,
we're happy to coordinate that for you.
awesome, thank you. The other question I
In
had
theory.
is... Thank you. The other question I had is, there's a vacancy for Ward 6.
That is correct.
Can you tell us what the next steps are to fill that in a minute or so?
I think interest is the next step.
Okay.
I think there has been one person who has expressed some interest. I think there was a review done of the application, and I need to follow up with that person and obtain more information. The application, I think, was maybe less than complete, so we're going to obtain a little more information.
I assume it's posted on the website?
The vacancy? Yes.
Okay, thank you.
Yeah, and that, actually, the Boards and Commissions Committee met last night, and we did hope that this evening we could kind of get the word out that we would entertain more applications as well. So that is still open.
Thank you.
Thanks.
Thank you. Next on our agenda is a presentation of the Local and Regional Economic Outlook by Dr. Tim Dewey. I thought I just saw him here. Awesome. Ta-da. Dr. Dewey, thank you for coming. Would you approach one of the podiums, please?
I'm good. Oh, are we ready?
We
Can
are.
you hear me? Sorry. As I was sitting there, I lost a contact. So half of you are very blurry, but we can still do this. This will work out just fine. So thank you for having me again. I appreciate the opportunity yeah, that's right. View is blurry, but the forecast is not. So here's what we're going to be doing today. We have 1 hour, correct? That's what I'm under the impression. So 2014, we're going to look at the economic outlook for 2015, some of the positives, some of the negatives, some of the concerns that we have looking forward for this year. A quick look at Oregon. Then we're going to look at the Salem area and how we've done over the recent year compared to the last time we visited this issue. And then also some job forecasts and some revenue implications as we proceed through the next hour. So, and feel free to ask me questions as we progress. So the U.S. economy overall finished out 2014 on a pretty strong note. I think it's not entirely appreciated that of the last 5 quarters, 2 of those quarters were above 4% growth and 2 were above 3% growth. That's fairly rapid pace of growth and fairly solid acceleration for the U.S. economy. It's looking that the weak first quarter number was really just an aberration. This means essentially the economy is feeling much more normal, I would say, than we've seen in quite some time. And I think that's very good news for the citizens of the country, certainly. When we look at whether we should be worried about a recession, I don't want to spend a lot of time on this. All the lines are up and pointed to the right. That's usually a good sign. If the lines are down and pointed to the right, then that's a bad sign. All of our recession indicators are saying, there's no reason even to think that there's going to be a recession anytime soon. So I think that's a good sign. And then as it comes down to matters that people really care about, non-farm payrolls have been growing. So job growth has been accelerating in the U.S. over 2014. So you look over 2014 and you see that the news, I think, was progressively better for the U.S. economy as a whole. There's, of course, some weak spots that still remain. And I don't want to spend too much time on the negatives per se. I think the big weak spot that people pointed to is that wage growth still hasn't come around on a national basis. So usually we think that when unemployment gets below 6%, that's probably the time that you're going to start seeing some upward pressure on wage growth. And that's certainly been the case in the past. We just really went behind under 6% in the last couple months. So I think your case for wage growth is just now coming into play as we look into the next 6 to 12 months. If we don't get that wage growth, that'll be interesting because that will tell us that the stories of underemployment in the economy are very relevant, that it's not just the unemployment rate that's relevant, but the fact that so many people still are part-time for economic reasons, which means they want a full-time job, but they can't find that full-time job, for example, or there's a lot of people sort of lurking in the wings of the labor force ready to come in when the market improves. So, we're still looking for some improvement on that front. Right? So in the general picture, we've seen some certainly good numbers from the national economy, from the national labor markets, from underlying indicators such as industrial production and consumption activity. What still is holding us back somewhat, and we'll talk about this more because it has impact on particularly municipal budgets in Oregon, is the housing market is just not bouncing back very quickly. That has been really one of the few holes, I would say, in this recovery that we're just not seeing the pace of residential construction pick up very quickly. And this is largely attributable to single-family housing. Multifamily housing has actually bounced back quite nicely. People have to live somewhere. And so that ends up being in multifamily housing. It's the single-family housing market that has not come along quite so aggressively. When we look at the multifamily housing, that's been particularly important in larger metro areas, though. And less important in smaller metro areas. So that's still, a particularly weak spot for the U.S. economy as a whole. And I'd like to emphasize that because we're seeing that on a lot of different local levels now. And I don't know that I could say that it's local specific issues that are at play. So housing's still a weak spot. On the bright spot, the contraction we saw in fiscal policy in 2013 is pretty much over. In 2013, we saw tax revenues go up quite sharply as we faded out some tax breaks. And we didn't see a concurrent rise in expenditures. As we've moved forward, we're starting to see the purse strings on a national basis loosen up a little bit, where the increase in receipts is not as steep, and we're actually now starting to see some new expenditures on the federal government side. This will then take out one source of weakness from the economy, that weak federal growth and the weak job growth that goes along with it. A lot of commenters have noted that this could be the first year in a while where government spending is at least neutral for the economy and not a drag. So I think that's certainly good news as we look into this next year. Another good point is that inflation has remained low. The nice thing about inflation remaining low is that the Federal Reserve is able to keep interest rates fairly low and support this recovery for a longer period of time. This is we're 5.5 years into this recovery. I am fairly confident it will last at least another 2 years, and I think it should last another 4 years. So I think that we have some room to run here, and one of the reasons we have room to run is because inflation hasn't been a real issue as of yet, and so there's no reason to think that the Federal Reserve needs to tighten monetary policy very quickly. And even when they do start tightening policy, this is maybe I should stop using this graph because it's kind of a wonky graph. All the red dots or all the colored dots here are projections of where normal measures of monetary policy would put interest rates over the next few years, given what the Federal Reserve's forecasts are. The black dots are where the Federal Reserve thinks that policy is headed. So what you see from that is the Federal Reserve expects that even when they start raising interest rates, the path that they'll be on is quite loose compared to past expansions. I have some questions on whether or not they'll actually even be able to raise interest rates that much, but that would lead us to a rather difficult hour-long discussion. That's probably beyond the scope of what we're worried about right here. So the summary on the U.S. side of the coin is that generally positive news. The U.S. economy left 2014 on a strong note. Most of our indicators are pointed upward. I guess one thing I would add to is that oil prices sank dramatically in recent months. That has traditionally been a net positive for the U.S. economy and certainly net positive for Oregon. We don't have a lot of oil wells here and oil producers. You might have noticed that. It's probably not going to be such a net positive for, say, Texas or North Dakota. Those are areas that will struggle a little bit more as a result of the fall in oil prices. There's been some concern in financial markets about some knockoff effects from falling oil prices, one being from maybe the debt or bank debt or bonds held or issued by energy companies, whether they'd be able to be repaid, what would be the financial implications of that. There's also been some concerns about global growth because certainly a lot of our trading partners are dependent upon oil for their revenues. One of our biggest trading partners, for example, would be Canada, and they just cut interest rates this morning in order to deal with the potential of a slowdown from oil. So there is some concern, I would say, caution that maybe we would have to think about bringing down some of the growth forecasts in the U.S. to account for weaker growth overseas. At the same time, consumer confidence went through the roof in these latest numbers, and that is often tied to faster consumer spending, and that's certainly a reflection of the drop in oil prices. So we could think about raising our forecast as a result of that. I think we'll be somewhere around 3% growth for the U.S. economy in 2014. Generally, I'm not so worried about the external factors because it's the domestic economy that really drives the boat here, so to speak. Any questions? Because that was just the rapid-fire U.S. review. I know you have a long night. All right. So driving then down to Oregon, which becomes then more relevant for all of us, Oregon has generally followed the U.S. patterns in this recovery, almost in lockstep. Initial jobless claims have fallen to very, very low levels. and at levels that are consistent with continued job growth going forward. So I think that's, again, good news. Firms just do not see any reason to lay off large numbers of workers at this point. Employment services payrolls, which is largely temporary help firms, have been rising. We tend to think that these are the first to hire and first to be fired, right, the temporary help workers. Hours worked in manufacturing went up quite sharply in 2013. It's come back down a little bit. They were well above normal levels in 2013. I think what we saw is firms hired on some workers to ease some of their employment issues. And then residential building permits in Oregon, very much like the U.S. numbers, they've been coming up since 2012, heavily dependent upon multifamily, particularly in the Portland region. Still well short of levels that we saw during the housing boom. Now, the good news, in particular, is that Oregon job growth has accelerated, I would say, dramatically over the past year and a half. Traditionally, Oregon grows faster than the U.S. economy as a whole, and the growth here is in the blue line for Oregon, and the green line is U.S. job growth. And you can see during expansions, it tends to be the blue line is above the green line. And that wasn't the case in the early stages of this recovery. In the early stages of this recovery, it was too heavily driven by Portland, and job growth was not shared enough by the rest of the state. That started to turn around in 2013, where we saw state local job growth start to pick up a little bit more aggressively and help lift these numbers. Today's job report for December was released, and it said that Oregon jobs were 3.2% higher than December of last year, and that's a fairly strong number. And I think somewhat stronger than maybe the state was anticipating. I have a couple different measures of how I aggregate these numbers. One is this one called the Oregon Measure of Economic Activity, a measure of growth. We're sort of following the blue line here. In this case is the important number. 0 for this measure is average growth. Typically during expansions, we're somewhere above 0. And we've been above 0 in Oregon for quite some time now, actually since 2013. But it looks like we've been accelerating in recent months as well. I would say it's still not to where we typically would see this number during an expansion. Unemployment is probably going to fall lower in Oregon. In fact, unemployment's ticked up a little bit as a result of more people entering the labor force, which is actually a good thing, not a bad thing. That's actually speaking to the strength of the recovery. Also, we would normally expect, again, residential building permits to be higher, and we just haven't seen that. But that's, again, a national problem. And then when I look at the U of O Index of Economic Indicators, what this is trying to measure is the economy going to continue to be in expansion or slip into recession? And all the indicators there, we're going to continue to expand as we move through the foreseeable future. So it really looks like Oregon is finally settling back into more normal patterns, just like the U.S. as a whole is settling back into normal economic patterns, or I should say normal, more traditional patterns. And I think that's certainly a good thing. That's hard to read. That would sort of show where my models suggest Oregon's job growth is going to go over the next until 2020. I kind of modify some of those models. The lower line here is the state's forecast, and the upper line is an unrestricted forecast. And that unrestricted forecast is giving me growth numbers that are too high on the U.S. side, and therefore translating into too high Oregon growth as well. I suspect that Oregon's growth is going to be a little bit higher than the state is currently forecasting as we move through the next couple of years, and that's going to be good news. But the state hasn't, I don't think, incorporated some of the latest news into their forecast yet. So I anticipate some upward revisions, but the state economist doesn't know I'm telling people that yet. So let's just keep it to ourselves. So. The state picture, very much like the U.S. picture. Compared to where we were 3 or 4 years ago, it seems like a whole different world, and it seems like a world much more like we knew back in the 1990s in some sense, because it's not driven by, we don't think it's driven by some unsustainable bubble like it was, like the housing market activity we saw in the last decade. So that is, again, I think, good news as we think about what's going to happen to local economies in 2015. anyone have a question now? I can take a break because I just, again, spit out a whole bunch of stuff. Okay. So then drill back down in the local area a little bit more and how we're looking at business conditions here. And again, we're seeing some similar patterns to what we see nationally on these numbers. Initial jobless claims in the county have dropped back to what we think of as normal levels. That's good. And employee growth, job growth, really started taking off in 2013 and continued in 2014. And we're looking closer, we're closer to hitting the peak of the last expansion, which, you know, it's in some sense of a milestone, a point of recovery for jobs. And so that's certainly good news. I would say right now, Portland is still the job leader, but Bend has grown jobs at a very rapid pace in the last year and a half as well. It's probably Eugene and Medford that are still a little bit lagging in the job growth recovery. It's been a little bit stronger here than those two regions. Where are we seeing the growth? Well, we're seeing it, well, virtually everywhere. So I think that's also a good sign for the region. We're seeing it in not just things that have been sort of obvious of late. For example, leisure and hospitality jobs. We know those have been growing strongly in Oregon for a while. But we're also seeing growth in the manufacturing jobs, construction jobs, trade, transportation, utilities, basically across the board, with some particularly heavy job growth in education and health services, and that's going to be mostly health services. That might be partially related to the ACA Act. It also might be partially related just the fact the economy is a little stronger, there's more jobs and probably some more people with insurance, and thus are driving some more need for medical care. But these are the kind of numbers that we're more used to seeing during an expansion, and certainly I think are really a change in the tone of the economy. Now, what kinds of jobs are they? I already said they're a broad mix of jobs. The state of Oregon Office of Economic Analysis has done some nice work on job polarization and trying to project job growth across different categories. And one of the concerns certainly has been, when are we going to get some of these middle wage jobs back? The middle wage jobs being ones that we traditionally associate with new household formation, thus adding some extra lift to these beleaguered housing markets that we've seen. And the good news is that certainly as the economy improves, we're seeing some of those middle wage jobs improve. And some of the components where you're likely to see this would include construction jobs, administrative and support services, government jobs, transportation and retailing jobs, or not retailing jobs so much, but wholesaling, transportation jobs, things that are often tied to a faster pace of economic growth. So hopefully as we move into the next couple of years, we'll see some of these middle wage jobs return.
What is the definition of a middle wage job?
So the definition here, I want to remember, as being somewhere around $40,000 to $60,000 a year in that zone. I'd have to go back and look, and I certainly can coordinate, give you a firm answer on that. Actually, I just had that question from a reporter. What is the middle class? Because you see estimates there from $25,000 to $75,000, and $25,000 seems far too low. So numbers, I think most people would say somewhere around $50,000 a year, which is close to median incomes, maybe 40 to 50. Right? But certainly, what we're trying to get a little bit away from is not so many, or not so few middle income jobs, maybe not so many lower income jobs. Of course, we can use all of the high income jobs that we want to throw at us, right? So I don't know that this is going to relieve the job polarization issue entirely, but it'll certainly start to make a dent and open up some more of this job growth in areas that have been particularly hampered during the recession. The value of new residential construction Started to rise in 2013, and then it locally sort of leveled out. And this is, again, this is the same pattern we've seen in national data and many statewide data. Is we got a little bit boost as we came off the bottom, but we haven't been able to sustain a lot of momentum in these numbers. I'll talk a little bit about that. What this means essentially, as I'm sure you know, is that we still have this problem of relative to where we were prior to the recession, we have this lost taxable value. Had we been building at those previous rates, we'd have a larger tax base than we do now. And again, this has been an issue for many municipalities across Oregon, if not almost all of them for that matter, and certainly is not easing off anytime soon. Some of these other economic indicators, I didn't want to spend too much time on them, but I did want to red flag the housing permits in the upper right-hand corner. Again, this is obviously related to the chart that we just had, and you can see where it rose and then dipped in 2013, 2014. I'm a little bit concerned about that sort of longer-term downward trend, though. I'm a little bit concerned that we're not sort of building the population locally that's building up new construction that's sort of impacting the pace of the increase of the tax base, and it's also a concern I have for some other parts of Oregon, including my own town. We had very rapid growth in the 90s and less rapid growth, but still fairly rapid growth in the last decade, and you can see a persistent downward trend there. That's something to think about as far as future forecasts.
Two quick questions. What's the time scales? I can't quite read it. What's the
95 to 2015, so 20 year span there. And I don't think that data set was pulling back any further than that, which is why that time span is there.
And you mentioned something about...
Member Bailey, could you use the microphone, please? Thank you.
Could you compare to other communities? I mean, is this unique to Salem? The long-term 20-year downtrend? This
is, I want to say, somewhat unique. The Eugene data has tended to be more sloppy than this. The Bend data took a hit, but you wouldn't see that data, and same for the Medford, you wouldn't see that long-term decline. Portland, the last decade was not as aggressive as the previous decade. If you remember the mid-1990s, that was a pretty rapid pace of activity, and so that might, in and of itself, be something of an unfair comparator to that particular era. But I'm still concerned that if I drew a trend line through that, the trends are less than favorable. And again, I'd say that Eugene is not rebounding very quickly on this metric either. Neither is anybody really. Medford being a concern hasn't seen the in-migration I think that they usually would see. Bend being the one place, the one smaller metro that's starting to catch on a little bit faster. I would say from that perspective. But even those numbers, still not a lot of housing activity. And I think across the housing space, and you look across the U.S., on the demand side, probably some changing tastes and preferences as demographics have changed. We've got a younger population moving forward that's not quite ready for owner-occupied housing in particular. You certainly have had a long period of low job growth and low wage growth, and that's not helping demand either. You've had a period of tighter financial conditions. That's not helping demand. On the supply side, financing conditions have not been amenable to speculative home building. That hasn't helped. Firms not seeing the demand, probably haven't been developing lots as quickly as they should. So you can sort of look around the host of the housing market and say this market was pretty broken by the recession and is having some hard time healing from it. But mostly the directions are positive. So in most of these locales, even though we've had low construction activity, we've still had pretty solid sales of housing. So if you talk to realtors, they're probably fairly optimistic. We just haven't been able to translate that into a lot more construction as of yet. Lodging revenue has been going up, basically across the state, is there has been much more tourism and travel activity. And this has been, I think, fairly good news. And you see that also follow from the leisure and hospitality hiring jobs numbers. Certainly that's been, again, a bright spot. And housing sales, we just talked about that, has been a bright spot. And this is either a bright spot or a low spot, depending on your point of view. This is solid waste. Generally, we think that as economies grow faster and get more people, they have more waste, which becomes more landfill waste and more recycling. That number has been rising since 2013, edging forward. And so typically associated with stronger economic activity.
Could you go back to the previous slide?
I could.
I am, this is, no, what I'm looking for is the, that one, revenue, lodging revenue. Is there any other matrix in reference to this, in reference to lodging or visitors to this community?
I'm sorry?
Is there any other, do you have any other metrics for?
The other good metric we have is education health services. I wonder if I put that slide, I don't have a slide of that one specifically, but leisure and hospitality job growth, which was 6.2%, another 800 jobs.
The reason I'm looking for this information is I see the housing and visitors as a traded sector business. It brings dollars in from outside of this community. It's not the traditional as you produce a widget and export it, but it does definitely bring in dollars from outside the community. So if there's a way that we can help that process, we get more dollars into this community, as you're showing, is doing rather quite well.
Right, and we're seeing that, again, across Oregon, where there has been much more. Some people would actually say it's a surprising rebound in this sector, where people have turned back to travel and hospitality, maybe over other sorts of consumer spending, as the recovery's continued. So, to the extent now, there's always going to be that concern that there's a number of lower income jobs in that category, and so that's also an issue in the background. But it's certainly one that has tended to be something that we've sold in Oregon, and those kinds of numbers, I would venture there's wherever that number was, I would venture there's a hotel plan somewhere in the bed is somebody's background. The back of somebody's mind, there's probably a plan to build a hotel. Whenever these numbers go up, and I say that, somebody builds a hotel in Eugene. So,
I know that the West Salem Urban Renewal Advisory Board has been looking at the possibility, could there be a hotel in West Salem? That's only one of many, but whatever encourages the people to come to this community to spend their dollars here is what I'm looking at.
Right, and we traditionally think of leisure and hospitality or travel along with some of these other sectors. Manufacturing as being these traded sector goods or traded sector opportunities that then we're able to build off on more strongly through the broader community. Right, so anything that brings dollars to the community from outside, traditionally a good thing. Yes.
To Warren's point, again, you're getting into my area of expertise here, but not only are the occupancy rates up in lodging, but the average daily rate, the amount they can demand for a room, is significantly up, and it's been up considerably up for the last 2 or 3 years. So, yeah, the lodging segment's doing really well. They're making hay right now while the sun's shining.
Right.
Yeah.
Right. No, and that's what we've seen. I've seen national numbers pointing in the same direction. It's been a stronger rebound than again many people would have expected. And so that's good news.
The other thing would be in Portland. I'm not sure there's any new hotels in Salem on the line, but Portland's building 3 major hotels in the next year. So.
I think we just announced a new plan for one in Eugene. Eugene's fairly under-hoteled. You also have a pretty nice hotel right downtown that's fairly recent, too. And so that's might have been some excess supply that's now starting to get soaked up as well. So that's, again, traditionally good cyclical indicators of where the underlying economy is headed. House prices have been recovering, and this has been a good thing. When we met last time, we didn't really have the data from the end of 2013. House prices were fairly stagnant. They weren't making a big lift. And then now that we have that data, we see that they were making a lift, and that lift continued into 2014. And that certainly helped ease some concerns about compression as we move away from some of the boundaries that we've created as far as tax base in the state. So that was an unexpected surprise and certainly represented an upside move to my forecast. We can see that Eugene and Salem both had positive momentum in their housing prices, but still not anywhere quite like Bend and Portland saw during that period of time. Again, Eugene and Salem in this category and being somewhat of a laggard, but what we really needed was just some upward movement to ease some of those compression concerns, and so we've been pretty fortunate with that. Arguably, we still have room to go. If we look at the trend in house price growth between 88 and 2004, and the 80s being the last time we saw a significant period of flat housing prices, and continued that trend forward, we're still well below that trend locally. And again, probably a combination of factors: a period of weak job growth, a period of weak wage growth, holding down prices relative to where we might have seen otherwise, and then financing issues and all the other things that I've already talked about. Housing prices on the rise and probably have some more room to go as the economy improves. Similar chart for Portland is closing that gap a little bit more quickly. And again, it's just the bigger economy, higher incomes, more inflow. The Eugene picture looks much more like this. But general direction is certainly positive. So I put some of these metrics together in another index, Salem Business Index, which has been turning upward since 2000 and the end of 2012, and certainly is directing us, suggesting that economic conditions here are improving and likely to continue improving heading forward. And so again, I think that's very good news for the local area. Unfortunately, yeah, I think as you know, sometimes these things don't translate in tax dollars quite as quickly as we would like, just because again we're held to this issue of the tax base being so dependent upon residential housing, and if we're not building that, we're still not making up revenue growth quite as quickly as we would like to certainly close the holes that are opening in our municipal budgets. And then another measure of activity I have. Would suggest that the Salem area has reached a much more normal pace of activity since 2013 and has been holding that. Still a little bit below what we saw in the 2001, 2003 period. The hit to the state was worse, believe it or not, than that time. But we're moving in the right direction, and I think that's certainly good news. And again, things that would help this measure out are pretty much some of the statewide things, including still lower unemployment rates that are likely to happen, and housing numbers getting better would be a big boost. Right. So this is from last year, and the dashed line there was my simulated or historical simulation forecast, basically assuming the economy had performed as it had prior to the recession. We would have been along that dashed line, and the local area wasn't quite keeping up to that dashed line. But I projected that in 2013, 2014, we'd start to see more closure. And that certainly happened with a bust or with a big bang. We had some revised data. I didn't think that dip in 2013 was likely to be sustained. And it wasn't, as the data was revised. Actually, what we saw is quite the opposite, is that we came back to that traditional level of jobs in Salem a little bit more quickly than I anticipated. And if, basically in many ways, this model has normalized, is that if I use the whole sample through the last data point in 2014 October, I pretty much get the same kind of path of jobs I would have had prior to the recession. And so, I'm optimistic that we are looking considerably better as far as the job forecast for the local community than we have in quite some time. And so as we move into next year, I expect to see continued growth and something similar to this forecast. And as I've already suggested, I don't really expect a reversal of this anytime in 2015 or even 2016. I do think that we still have room to run on this expansion going forward. So, I think we've talked about some of the implications along the way. Is that hopefully, as we move through 2015 and as we have more job growth and some of this healing happens in the housing market, we'll end up getting a couple things happen. Is that on a national basis, we'll see more job migration, more movement, and that traditionally benefits Oregon. And that coupled with stronger job growth and higher wage gains and easier financing conditions all should then offer some support for housing markets as well. And maybe we'll see some more interest in new home construction going forward, and particularly owner-occupied housing. So that would be the longer-term positive trends for these communities if we can get that. In the near term, we're just constrained by the fact that one of our key revenue bases is just not growing as quickly as we probably need in most of our communities to keep up with the cost structure. That was a fairly rapid pace, but I don't want to make sure there's time for questions.
Where it shows non-farm payrolls, that we have more jobs in the community, it's rising nicely. Is that just a job for being a job, or is that sectioned out as part-time, full-time type
It is
jobs?
just a job for being a job.
Okay.
If you look at this, we don't necessarily have great local measures of some of that, but if we look at some of the state measures, that what we call underemployment is in the national data too. Those measures of underemployment are improving. So we're moving, further away from, or reducing the number of part-time jobs of underemployed people in general. So again, those numbers have certainly been elevated during this recession, but we're moving them back more toward normal. So that is really mostly a feature of just stronger growth. Being closer to 5% unemployment than 7% unemployment, having faster revenue growth for our firms, that will start to improve some of those conditions. Firms just won't be able to find part-time workers, and they won't have a justification for them either, I think, as we move forward.
Okay, yeah, because in many of my travels, most of the people that I meet typically have 2 or even 3 jobs. So even though job forecasting looks good here, it's, well, one person's got, 3 jobs or 2 jobs.
So you remain right in the sense that underlying most of our trends for the last 15, 20 years, or particularly since 2000, I would say, you have this persistent problems of what they amount to is some form of income inequality, and these situations where people are working multiple jobs, either part-time jobs, and we've had, arguably, and look at the table outside of the housing bubble, from about 2000 till I would say now, has not been a particularly great economic time. So really what the objective of national policymakers should be at this point to keep this party rolling as long as we can going forward. And that would help to start to ease some of those exact problems that are still in the background here. I just don't want to do too much negative stuff today.
I understand. Thank you.
Anything else I can do? You want to send me away?
I had a question for you.
Okay.
You have, in the past, if my memory serves me right, introduced a curious economic indicator of waste production.
Right.
Do you have any update there?
That was, go up.
Or did I miss that?
Update. Waste is going up.
There we go. Okay.
Waste is going up. It's going up in a lot of places. As economy improves, also some of this is additional construction. Construction creates some waste too. Moving in the general strong direction. You'll actually see these numbers move more if we have population growth too, adding on to it, because then, you know, even with recycling efforts, have a new person in, they will drive, you know, more garbage most likely. So we're likely to see this number, I think, move higher if we get a little bit more, again, population growth, household formation, building activity.
Thank you.
It's one of the ones that people either love or hate because nobody likes to think of waste as a good thing, but it tends to rise during expansion. So that's what I care about.
Thank you very much, Dr. Dewey. It's certainly a nice thing to have such a positive report after what we've been through for the last few years. We appreciate your information.
Well, good. I hope it's helpful. Thank you for your time.
Thank you. Thank you. Next on our agenda is our own city manager, Linda Norris, with a 5-year forecast.
I've heard of her.
I'm throwing staff off because I was going to do it from my desk. So you have in front of you the 5-year financial forecast. For the last 2 or 3 years, we've been doing a forecast for some additional funds, and this is the first time we bound it all in one document. So we have the general fund, the Transportation Services Fund, which was previously called the Public Works Fund, but we thought that was a little confusing sometimes to people. It really is Transportation Services, and so we're changing that name. The Building and Safety Fund and the Water and Sewer Fund. And so I'm going to hit the highlights of each of these funds and tell you what I think some of the major good news or issues are and how we anticipate that happening. I would appreciate you actually, and I think you'd find it very interesting later after the meeting, actually going through the document and reading the information. And I do want to thank Kelly Jacobs and Ryan Zink and Kelly Lindbacher for all of the hard work you've done on this budget. They've been here day, night, and weekends on the forecast, putting this together and making sure that all the information was correct. And we've also had, of course, support from the departments who are involved here. Try this. There. The first forecast I want to go over is a general fund forecast, and just 2 major points. We continue to have that imbalance between revenues and expenditures throughout the 5-year forecast. That's going to be true as long as we have a property tax cap of 3%, because property tax is most of our revenue that we have in the general fund, and as long as the other revenue sources that we have remain fairly flat, which continues to be the case. We have potential service reductions of about $7.2 million over the last 4 years of the forecast. It would be a little less than that if we start next year. Absent new or additional revenue sources, and depending on the outcome of the PERS litigation. In the budget that we'll be recommending to you, it'll come to the Budget Committee in April. I'm, at this point, not recommending cuts next year, because if the outcome of the PERS litigation is that cities, counties, and states win that lawsuit, then we wouldn't have cuts of even close to this kind of magnitude. So we are still in that situation of wanting to make sure we don't cut too much too soon. We still have quite a bit of uncertainty, but that'll be something for the Budget Committee to weigh and give direction on. Yes.
What would the projected amount for PERS savings be if it was available?
It's between about 2 and 2.6 million per year difference. So that could make a big difference on what we have to do going forward. So these are some of the main points. Again, we have that disparity between expenditures and revenue. Property tax is growing about 2.8 to 3.2%. And as I said, most of the other revenue sources are flat, and I'll show you more detail about that in a minute. We forecasted here in the financial forecast, and we are as well in our budget recommendation for next year, the last PERS rates we got if we're not successful in the lawsuit. And we are not, in the budget recommendations and in this forecast especially, we're not anticipating winning the lawsuit just because we don't want to count revenue or count savings before we have it. We anticipate another year of very lean operations in the next budget year. Cuts perhaps mid-year, depending on what happens with that PERS lawsuit. In the forecast, we're assuming the $400,000 per year of the solid waste franchise fee, which Council just adopted a few months ago, in years 2 through 5. We put it in the forecast and in next year's recommended budget. It's moving into transportation services, as we've discussed with Council. But I left it in the general fund for purposes of the forecast and budget, because that will be a budget committee recommendation and a city council decision as we move forward. Wherever it goes, it helps that fund. Wherever it leaves, it creates a deeper hole in the fund. So, you know, it's kind of a Sophie's choice of what you do with that. So this shows current year revenue sources for FY16, the next budget year. Property tax, we expect a little over $60 million. That's a 3% increase, which is a wonderful thing. It's not at the about 5.5% rate that we had in more productive years, but it's certainly better than it's been the last few years. Franchise fees are going up. Only we had an additional bump last year, so or will this year. After FY16, only about 1%. You can see the internal service charges about 2%, state shared revenue 3% increase, but on a much smaller amount of money, only about $5 million, and fees for service 2.3. So you can see that. We expect about $102 million to be received in the by the end of this current fiscal year, June 30th, and about 1.6 next year. So at least it's going in the right direction, but it's not adequate for what we need for even the services that we currently provide. So one of the things that's always, and I know the current counselors know this, but I want to emphasize it, that is always kind of surprising for a fund. General fund revenue has absolutely no relation to what our service needs are, how many calls for service we get, what the workload is, what council's priorities are, what our labor and equipment needs are, or our general fund facility needs. And so we're not able to address many of those areas. And it's interesting, essentially running businesses where your revenue has no relation to the work that you're doing. So that's what makes it very challenging, and what causes us to always be watching this so closely and to have to adjust our services as we go. Do you have any questions about that? Does that make sense to everyone? Okay. So this is Schedule A, and this is the one without any corrective steps, and what would happen if we don't make any cuts going forward and we don't manage our way through this. And you could see we would be below council's goal of a 15% ending fund balance by the end of this second year here. And so we never do any more Schedule A, except you will see when we get to the water and sewer fund, we only have a Schedule A. So that's good news. We won't take any corrective action. I wanted to show you something with property tax revenue. You can see in the top line what we anticipate for property tax revenue each of the years over the 5-year forecast, and how much police and fire alone are going to cost over those years. So we continue to be in that situation where all of the property tax, which is about 57% of our general fund revenue, doesn't even cover police and fire services. And then we have all of our other general fund services that are funded out of very small amounts of revenue. So this would be Schedule B, and that's with some corrective steps. That's service reductions. We just did a even amount every year on this schedule, cutting 1.8 million every year beginning in 2 years from now in 16-17. And you can see that we keep an adequate balance. We keep an ending working capital within council's goals of 15% during that time period, assuming all of the forecast assumptions are correct. You know, and they can change over 5 years.
So I want to explore this just a tad. You talk about if we, Schedule B is if we cut $1.8 million per year.
Right.
Yet I see the net expenditures going up on each and every year. So do you want to explain the difference between those two?
Yes. Well, costs continue to go up. Labor costs go up. Health insurance costs go up. PERS costs, you know, likely will go up. So our costs continue to go up, but even with that, we still have to cut an extra 1.8 million to keep it at this level.
So instead of 109 million,
it would have been higher.
Would have been higher.
Yes. Yes. It's my constant challenge. So general fund summary, and this really is just hitting the high points, but you can read more of the details in the forecast. If we have a negative PERS lawsuit outcome, we're not right now projecting cuts for the 16 budget, but when we get to that point, we may decide to do mid-year cuts. Cuts of about 1.8 million for the 4 years, not next year, but the 4 years after that. We're asking departments to have a savings target of 2.5%. That is going to be very, very difficult for, I think, every department. We've given budget targets to each department to make sure we end up at the ending working capital number we need to end up at the end of next year, and are assuming 2.5% savings. If departments don't feel they'll be able to do that through either position vacancies or finding a less expensive way to do something, I've asked them to recommend to me what cuts they'll make from their current operations so that we achieve that. Because if we don't achieve it in any 1 year, it causes a bigger imbalance in the following year. Member Lewis.
Yeah. Well, 2 questions, I guess.
Yes.
The Supreme Court decision on the PERS issue, when is that due?
We anticipate we'll know sometime in March, by the end of March.
So pretty soon.
Yes.
And I think I heard you say that that's about a $2.5 million a year issue. So if the Supreme Court upholds the PERS cuts, and you're talking about cutting 1.8 million, and that would save you $2.5 million a year.
Yeah.
So
then
you'll
we're
have
only projecting cuts, and we have a schedule for that in your forecast that you'll see. We're only projecting needing to do cuts the last 2 years of the forecast if all the projections hold. And of course, if revenue's higher or expenditures aren't as high as we assume, you know, that may not be required by that by those years.
My question is, if the lawsuit goes in the favor of the PERS cuts, then my arithmetic shows you won't have to make any cuts. Is that correct?
We will still make them. And Kelly, can you help me which page that's on in the forecast?
Actually, I think that was side material that I provided to you.
I'm sorry.
We opted not to put that schedule in the forecast document simply to maintain 2 schedules for the general fund. But what we were looking at is that we would not need to make reductions if we continued to allow ending working capital to decline. To maintain a particular level of ending working capital that was within council policy, we would have to make some reductions beginning in the 3rd or 4th year of the forecast.
I think it's the 4th and 5th years.
Yeah, even with the savings from the PERS rate relief. And it's just all about keeping that ending working capital at a particular level to keep the fund healthy for, you know, the next year.
Right.
Okay, so it would hold off the cuts to the 4th or 5th year.
Right, we'd still have some. Not of this magnitude, though. Yeah.
I think as a continue on with this, the expenditures will continue to go up.
Mm-hmm.
And so we're just not going up as fast. So it's not going up as fast as considered a cut. I just wanted to make that clear.
That's right.
That it's still going up. It's just not going up as fast as we would like for the expenditures that we have.
That's right, for our current service levels.
Right.
Okay. And then we're assuming in the forecast that we would spend no more than $200,000 each year out of the $2.5 million general fund contingency. So if we had a year where we had some kind of catastrophic event and had to spend $1 million of that, then that's a further hold that we have in the following year. So fortunately, we have not had to do that. It would be very rare. When we had the flood of 2012, we used some general fund contingency money, but we were able to get reimbursed from the federal government for most of those costs. So we always hope that that doesn't happen. If we have a positive PERS outcome, reduced again by 2 to 2.6 million each year, and it covers our current operational costs for year 1 through 3, and again, years 4 and 5 would have to make some reductions. And of about a total of $2.5 million on year 4 and 5, if all of our forecast assumptions hold. Okay. Remember, we're forecasting out 5 years. We're getting pretty good at it, though. They've been holding very well from what, if you look at last year's forecast to this year's forecast, you'll see that we've been pretty accurate with that. So here are some of the general fund revenue risks. Property tax limitation is a high risk. We have come out of about half of the compression that we were in before this year, which has been a wonderful thing. We'll continue, hopefully, to come out a little bit more of that each year. But once we get to that 3%, unless we have additional new construction, we're at 3%. So it's really new construction after that that brings in more property tax revenue. State shared revenue, we think that's about a medium risk. We've been able, cigarette tax is dropping, which is a good thing for society, but some of the other state shared revenue is increasing. Franchise fees, medium risk. We think there's some legislation that could change our ability to collect franchise fees or to collect it at the rate we're collecting it right now, so we have that as a medium risk. So that is, maybe I'll go back up. So those are the high points for the general fund 5-year financial forecast. Do you have any other questions about that? Okay. Going on to the Transportation Service Fund, and again, this is street maintenance and sidewalks and signals and signs and all of the other type of work that we do along the streets. Again, that same imbalance. Without any new or additional revenue, and I'm going to talk a little bit more about a proposed streetlight fee, we'll have service reductions of $2 million in next year's budget. The main points were continued imbalance between costs and revenue. FY16, we have in that year some one-time money from street bond that council asked us to move over to do some sidewalk repairs, and it's also in this year's budget, but that goes away after that year. As I said, next year we'll move the $400,000 in projected revenue from the solid waste franchise fee to street maintenance. It will require a new revenue, and the new revenue, if council decides to do a streetlight fee, will only stabilize this fund for 3 years, but it gives us 3 years to plan for what to do next. We have a $258,000 increase for costs of converting some seasonal positions to full-time positions. There's an Affordable Care Act requirement of when you start paying health insurance for seasonal employees, and with the kind of work we do in streets, they need to work more than 6 months. Our season is more than 6 months of the year. So that requires us to move some of these positions to full-time instead of having so many seasonal employees. And again, they're going to have expenditure savings of 2% each year to be able to maintain the services or the scenario that you're going to see here. Yes, Member Dickey.
So with that requirement for the seasonal employees, I'm wondering, so you would bring them into something that's longer than 6 months, or it's already longer than 6 months for the schedule?
It is already longer.
So would that be then a full-time, a year-round job?
Yes.
So I guess I'm just wondering then, because we would have to put out the funds to bring them on, what else would they be able to do, and would that increase our capacity in some other areas?
Yes, Mr. Bechtel.
Mark Bechtel, Parks and Transportation Services Manager. Currently, before the Affordable Care Act took place, most of our seasonal workers in streets have been 9 months, anywhere between 8 and 9 months per year. And then that encompasses most of the maintenance season. And sometimes we even stagger those so that we can cover the whole year. What's happening is with the Affordable Care Act, after 6 months, we either have to start paying them benefits, or at that point, you're almost mathematically at the point where you're better off having them be a full-time employee. Also, there's some issues with how you get insurance for that time period in between. So our recommendation is not to do every seasonal to a full-time, but just to pick some key positions that are now currently seasonal, make them full-time. And we will still be using seasonal workers for the majority of our seasonal needs, but we'll be limited to 6 months. And that will create some issues when you're trying to find people that have concrete finishing skills, commercial driver's licenses, heavy equipment operating skills. They don't necessarily want to work just 6 months out of the year. So we're going to wait and see how that impacts the workforce.
And I think the question mark is, what additional work would they do in the 3 additional months that they'd be working?
Well, we do street maintenance year-round. We do sidewalk repair year-round, and we do pothole patching and gravel work during the winter time. So we are so understaffed right now that any amount of additional labor is needed. So.
Thank you. Yes, ma'am.
Does the Affordable Care Act prevent a municipality from contracting for temporary labor, for, contracted labor through temp services?
No, it doesn't prevent that. No.
Okay.
No, but the Affordable Care Act affects every employer in the country. It's not just a provision on local government. Every employer in the country now can only hire seasonally 6 months or less without having to pay benefits. So that's creating ripple effects through contractors all around the valley here, as they also have construction seasons that go longer than 6 months. Mm-hmm. So it'll be an interesting impact on the workforce.
Mm-hmm. I can see that. Okay.
Is it all right if I call on people?
Yes. Thank you. The noise I'm seeing in the paper about potential legislative action on gas taxes.
Yes.
Where does that ripple in? Would it be in this budget or in the shared revenues, state shared revenues? Not that it really matters.
We've done a little bit of research on what the state's looking at. We don't believe it's going to have, it's going to provide much help to cities.
Okay.
And Mark?
Yeah, there's a couple things that are going on at the state level. The Oregon Transportation Forum, which is a consortium of many different interest groups. I think that's what you're probably referring to. They have put together a very broad outline of what they would like to see in a statewide transportation funding package. But that plan hasn't been turned into legislation yet or any kind of specifics. The governor has indicated an interest in convening a blue ribbon panel to look at statewide transportation policy over the whole gamut of policy: funding, organization, formulas, land use and transportation. And then we did hear an indication from the League of Oregon Cities that the leadership of the legislature, the Speaker and the Senate President, would be amenable to a transportation package, but the transportation chairs of both houses have no legislation put together. So it might work, it might not work. What we hear is that there's a lot of interest in capital funding, more so than maybe day-to-day maintenance.
Yeah. Right, right. We need capital funding as well, so that would be beneficial to us if some came to the city, but it doesn't solve this fund's issues. This is the revenue. We have, most of our revenue comes from state highway gas tax. You can see 9.1 million. Then we have the next biggest source is transfers and internal charges for work, for example, that Mark's crews would do for water and sewer, for example. We have other agency revenue and grants, very small amount, and all other sources. So you can see we have 12.7 million in anticipated revenue for this fund. Mayor.
I know that we've been having some conversations out in the community about having a streetlight fee.
Right.
And are any of those scenarios contained in this forecast?
There is one, and I'm going to go
Okay.
over that here
Oh,
as well.
okay.
So this is Schedule A if we don't do anything, and you can see that we'll do okay, not with an adequate ending fund balance at the end of 2015-16. We would be violating budget law if we didn't do anything. So we're at the point, we've been talking about the need for transportation revenue for probably 6 or 7 years. We're at the point where we have to do something, that we're going to have a big problem if we don't get some more revenue here, or unless we're willing to cut services dramatically. Schedule B, this shows the $500,000 for sidewalks, in the next, it's this year and next year, $400,000 next year from the additional solid waste franchise fees, and then service reductions of $2 million for the forecast period. And you can see that the ending fund balance is still quite low with that scenario. Then the third one, and Mayor, this is the one that we would assume a street light fee, just to show you what the difference would be. So the same with the $500,000, the $400,000, and then potentially a street light fee that would go into place, be effective on July 1st, but we wouldn't actually start receiving the money for about a month and a half after that. So we would anticipate still paying the electric costs for the street lights and traffic signals for the first 2 months of the next fiscal year. And for those of you who maybe aren't familiar with what we've been talking about, it's a small fee. We're recommending it would be $2.80 a month on the utility bill for about 93% of our customers, and then it graduated for a little bit more for multifamily, small multifamily, a little higher than that for large multifamily, and a little higher, I think it goes up to $18, a little in change for larger commercial and industrial. So this is what would happen if council decided to go forward with that type of fee. The street light fee would pay for, it would be in its own fund, it would pay the electricity for the street lights and the traffic signals. It would pay for pole replacement when we need to do that. It would pay for adding more street lights in areas of town that are too dark and where people want more street lights. And then would also have money to convert to LED lights that would save electricity costs as we go forward. Councilor, or Member Bernard.
So I see, despite the addition in this particular scenario on Schedule C of the streetlight fee, we still have diminishing ending working capital.
That's right. It only helps this fund for 3 years. Excuse me. The street light fund would be stable for 6 years. Excuse me. Before we would have to increase those rates. It frees up the $1.4 million that we're paying for electricity costs right now. But again, because costs of material and labor and all of those other things go up, it only solves this problem for 3 years. But it gives us 3 years to address the other problem in this fund.
Missing something, but why just 3 years? It goes to 17, 18?
Oh, I'm sorry. There, Mark was just giving me a little bit of information too. Well, first of all, there is an error on my slide that I'd like to point out. It says that the service reductions begin in 16, 17. They actually begin in 17, 18.
That's right.
So we do have a period of time in this scenario without reductions. And then, Mark, you had something you wanted to add.
I think a key factor why you see reductions is that we have a bunch of one-time revenue
Right.
in the
That's
street
leaving.
fund. You have that $500,000 in bond money for sidewalk repair that we're using the current fiscal year. We have again in 15, 16, and then we're done. So that's a $500,000. And then the forecast is only showing 1 year of that $400,000 in franchise fees. So that's, as Linda said, wherever you put it, it helps the fund or it hurts where you take it from. But if you don't include that $400,000 in the street fund, that's a $900,000 hole.
Hit.
So the one-time money's taken out is what helps create that problem in years 3 and 4.
Right.
Yeah.
So has this been run out far enough where we know where we're going to have to do something with that streetlight fee, i.e. increase it at that point? Or have you, what if you kept the streetlight fee?
fund would be okay, but the transportation fund, this fund, I would say in the next year, we have to start working on how we're
Yeah.
going to solve it for the 4th years on.
Wow, thanks.
Yeah. Yes.
So if I'm hearing it correctly, in theory, the streetlight fee, at some point, will be able to maintain itself just for the streetlights because of the cost savings.
Well, it's not theory. We know when we model it, it'll be able to, we'll keep it at this, be able to keep it at the same rates for 6 years.
Mhm.
That will take care of the streetlights, electric costs, conversion to LED. It helps a transportation fund for 3 years, and then we need to do something else with our maintenance costs and the other needs that we have in this area.
Okay. Thinking out loud,
Sure.
you replace the bulbs, that's going to be a big expenditure up front.
Yeah.
Okay.
It'll take about $3 million to do the conversion to LED lights.
And the reason why we want to do that is to reduce the cost of electricity annually.
Over time.
Over time. And so, at that point, that savings would actually go in or help with the street fund.
No, that savings will stay in the street
Okay.
light fund, and maybe we'll extend, maybe it goes out 7 years
Right.
instead of 6 years. You know, but we'll have to see that. The model looks like we won't have to raise the rates for 6 years.
Because the way I'm looking at it is that, okay, how many poles are we going to add? How many poles do we have to replace? Taking into account that we're going to be putting LEDs in the new ones anyway. And then just the cost of electricity, not knowing if that's going to fluctuate or go up as rapidly as...
We are anticipating electric costs to go
Go
up,
up.
and we have a pretty good estimate of what that could be.
Okay, all right, thank you.
Yeah. Yes.
So what's the payback for the LED lights?
It's about a 9-year, David, do you want to come up? David Lacey from our finance department has been doing all of this modeling.
Sure, David Lacey from Administrative Services. So when we've modeled out the street light fee, just to kind of answer some of the general questions too, we pay electricity through the form of tariff rates, and then also depending on the type of lights and the type of services that we have. There's 3 different types, option A, B, and C through PG and Salem Electric. Option A are lights that the utilities own. We essentially pay rent for the fixture prices and things like that too. Option B are ones that we own and they maintain. PG is going to stop doing that with the conversions of LEDs, so that's one of the reasons that we've had to look at a streetlight fee of either selling those lights to PG or deciding to own those and turn them into option C, where the city of Salem would own those and then relamp those. But the payback that we've looked at that at this point is between about 8 to 9 years, depending on how costs increase and things like that. So.
And the LED bulbs last at least 10 years, and some of the information is it could be as much as 21 years.
Yeah, so the technology is actually a little different. It's not necessarily a bulb. We would be actually changing out the entire fixture. So it's not using the existing fixtures and changing out a bulb. It's actually a new unit that would be installed on each pole with different wattages, and we'd be using the tariff rates that PG is already established for LED lights that they've installed, part of those lights in Salem. So those would be the rates that we've been modeling out at this point.
So, so you got a 9-year payback. We've got a shortfall already. I guess long-term, I understand you're going to save money after 9 years on electricity, but the short-term fact is we can't afford to pay with what we've maintain or use what we've got now. So why would we be paying something that takes 9 years to pay? I mean, the savings isn't realized, and we're going to be cutting services.
We would, so if we set up a streetlight fee, we wouldn't do it absent a streetlight fee. And the money generated from that streetlight fee would generate enough money so we can borrow $3 million and pay the debt service as well as all the maintenance costs. And from the borrowing be able to do the LED conversion. And then there's additional money that would be generated to do the pole replacement. If we don't have a streetlight fee, we're going to have trouble just paying the electricity costs and doing the same level of maintenance that we're doing right now.
I'm not really, the streetlight fee is fine. I'm just saying we get a streetlight fee to do the maintenance. Forget the LED. I mean, you've got maintenance, you've got additions, you've got the things you've got to do to maintain it. At the same time, we're converting it to something that's going to take 9 years to get it back. I'm just wondering if that's the best use of that money, short-term, when you got a short-term issue that you're still dealing
Yeah.
with.
Well, we have two issues. One is if we pay for the street light, if we had a street light fee, and this is just an example, and we'll have a better presentation for this when we bring that issue to a public hearing on February 23rd. But that takes care of half the problem with how we deal with the electric charges, and then how we do, you know, the relamping and the other things we need to do just to maintain that part of the system. Because it frees up the money we're paying for our electricity charges now, it gives us an additional $1.4 million every year for that helps us for maintenance over the next 3 years. But then costs increase and we need to find another solution. So we actually have two problems to solve here. And so we can handle the first issue right away if council chooses to do that. But then we haven't solved the entire transportation service fund issue. We have to come back and solve the maintenance issue after that. Last year, council looked at a scenario that would deal with both the street light and electric costs as well as the maintenance, and people found it too hard to understand. It was, the community just was confused about how much money was for maintenance and how much was for electricity. So we've tried to simplify it, to bring it back so it's easier to understand. And I could see that it was. So we'll do a better explanation. Yes, Mark.
Linda, just a little bit of clarification too. We want to make sure it's understood that we're actually establishing a new fund in the budget for streetlights. And so the streetlight fee becomes the funding source, the sole funding source for what would become Fund 156 streetlights. Right. And that fund has the 9-year payback to it. That fund, with fixtures that last 21 years, of the 9-year payback, that's a good return on investment. So that's, you know, that fund is stable for 6 years. It's a rate that you as council would set and not have to worry about it for several years if all our assumptions are true. The street or the transportation services fund is the one, as Linda's been explaining, is the one that has the more immediate need. Even with that $1.4 million being redirected, we have that one-time money that creates a hole in the out years. So that, to make sure that I understand, there's two separate funds that we're talking about.
Okay. Thank you. So this is the fund summary that from the if we win the PERS lawsuit, that would be about $140,000 savings, a cost reduction each year in this fund. Corrective steps, again, are needed now to maintain the reduced service levels. The service levels have been reduced over the last several years. Without taking additional steps, we'll have service reductions in sidewalk repair and maintenance beginning next year. And again, talking about the February 23rd public hearing for a potential streetlight fee. And that was probably more a discussion that we intended to have tonight, because really the discussion should be at the public hearing. Okay, sure. In terms of the risks for revenue, the State Highway Fund, high risk. We find that as more people drive energy-efficient vehicles, we're receiving less revenue. The December revenue we received from gas tax was about $70,000 less than we anticipated receiving that month. It's still very volatile. And it's a big concern about whether that's going to be enough even to maintain what it's been maintaining right now. So that's it for transportation. So before I go on, yeah.
So the projections you made for the gas tax were based on how much a gallon versus, I mean, I just bought it for $1.99 a gallon on the way up here.
Yes.
You know?
Go ahead. I jumped ahead somehow.
Sure. Just as a review, the gas tax, the allocation that we get at the city is an allocation of the what we call the gas tax. It's a state highway fund. It has retail motor vehicle fuel taxes, the weight mile tax, and all your DMV title registration licensing revenue. That's the state highway fund. We get an allocation of that. But the gas tax is so many cents per gallon, so it's all consumption based. It has no reference to the price. And we just got a report from yesterday, and you would think that we would be getting a little bit of a windfall given how cheap gasoline has become. But I don't know if it's just the makeup of the fleet we have right now, but we actually got $70,000 less than we had anticipated. And then, you know, in a month where we should be seeing all sorts of additional consumption, and we're not. The vehicle fleet is just more fuel efficient, is what we're guessing.
Any other Transportation Service Fund questions? Okay. Next one is Building and Safety Fund. The key issue, as you heard from Dr. Dewey's presentation, is we have very slow or no growth in permit activity. Working capital remains within policy throughout the forecast period, though, so that's the good news. So our FY14 permits and the valuation for those permit projects showed steady improvement, but this current fiscal year shows a decline with no large projects predicted. So we are definitely seeing the trends that Dr. Dewey showed about residential construction. Dwelling permit activity remains slow. We're only projecting a 1.5% annual increase in permit revenue. If we have new large construction projects, that can be a very positive thing for this fund, but we're not projecting that through the 5-year forecast because we wanted to make sure if that doesn't happen, if permit activity remains slow and very little growth, that we still will be stable through the 5-year forecast period. So again, we have required reserves in here. We have a 6-month stabilization reserve as well as an ending working capital. So we anticipate being balanced over the 5 years, but we will have some ending fund balance decrease over that period of time, unless, again, we have those large construction projects. This shows revenue, $2.9 million from permits. All other sources, very small. Total revenue, about 3.1%. So you can see 1 to 1.5% growth in terms of revenue. And this is Schedule A. So you can see that the ending working capital will decline, but will still be within policy, within council policy over this time, even if we have this slow growth. We've kind of staffed for that. So we anticipate this fund being stable over the 5 years. So this summary, just so you know, a positive PERS outcome results in about $80,000 of savings each year that would help increase the ending working capital a bit. And again, one new large project, if the state decides to do the state capital renovation project, it could result in ending working capital of about $5.5 to $6.7 million instead of what you just saw on the last chart. And annual savings about $100,000 per year are going to be required in this fund. Any questions about building and safety? Okay. Permit revenue, that the risk is high because it's 93% of the revenue in this fund, and it's slow. So the next is water and sewer fund forecasts. Rate revenue growth is adequate to fund our operations, and working capital remains within our bond and reserve requirements. This fund is stable, and we were happy to see that water consumption finally started increasing. We had a long, dry spring and summer, and that seemed to help, and we're hoping that that will continue. We additional.
Just in my leak this year.
I know. Additional revenue we receive will be allocated, has been allocated next year's budget, and we're anticipating that in the 5-year financial forecast to fund some, a few of those significant capital needs that we have that are not funded right now. As you know, we're on a pay-as-we-go plan with capital projects in this fund while we continue to retire our debt service. City Council did adopt a 3% rate increase effective this January 1st and a 3% increase next January. A positive PERS lawsuit outcome here will result in savings of about $950,000 each year, which again can be reallocated to project costs, and we certainly have millions of dollars of needs in project costs, so that'll be good news for this fund. This shows utility rates at 75.4 million, all other sources about 12.4, with total revenue, current revenue anticipated of 87.8. By current revenue, I mean the revenue that we'll receive next year, not the previous ending working fund balance. Schedule A, and as I said before, we only have a Schedule A in this fund. I'm hoping someday to see that that would be true with the general fund. But we'll have adequate ending working capital throughout the 5-year period. Utility rate revenue, we've given it a medium risk rating just because it's such a large percentage of the revenue in this fund. So for citywide financial outlook, the Water and Sewer Fund, Building and Safety Fund are stable, although we're concerned about the permit activity and valuation. Stabilizing the Transportation Fund is going to require some additional revenue. General Fund, the reductions are needed, but if we lose, lose the PERS lawsuit, if we win, smaller reductions. I'll tell you now, the general fund budget targets for next year are really insufficient for every single department. So every department is having to think about where they can reduce and how they can save money as we go forward next year. I'm concerned about whether we'll be able to meet the 2.5% savings targets. Without new revenue sources for general fund and the mandated 3% cap on property tax, we'll continue to have expenditure cuts every year. Forever, I think. And sometimes people ask me, well, when are we going to be able to add back a program, or when can we reopen a fire station? I would recommend not until we know that our current revenue is going to be higher than our current expenditures for a few years in a row. Because we just can't do that when we're using one-time money or continue to have this instability. So that is the general fund financial forecast. Do you have any questions? And again, I urge you to read the more detailed explanation in the forecast document. Any other questions or comments?
I have a question.
Oh, yes.
At the recent task force meeting for the public safety facility, there were people on the task force recommending that the city begin to look for money that we would use from the general fund to pay for design and planning, et cetera. If indeed we were to do that, where in the world would we look for that, and what impact would that have on the rest of the fund? And I think this is a good time to talk about it because you've laid out the 5-year forecast, and we'll be going back to that task force, and an answer, I think, to them is
right.
A good idea.
And I'm probably tired of saying it, as other people are of hearing it, but to find additional money means we have to cut something we're doing now. So we would have to do something. Say it's $250,000. That's about the amount of an inmate crew that helps do all of the maintenance along our public right-of-ways and helps us with park maintenance, or would have to lay off a few positions in the general fund to have that revenue, or next year we're going to have to invest some in our computer hardware and software to make sure that we can maintain these systems with the security that we need and the robust systems that we need in the city. Would have to cut those, which I think would have potentially bad impact. I wouldn't recommend that. But there are not any easy places to cut. We've been cutting now for 8 years, and there's nothing that I would say, well, we can definitely do without this. That's one of the difficulties we're having putting next year's budget recommendation together, is because, as I said, no department, including the city manager's office budget, which is pretty small, feels like we're going to have enough money to do what we need to do next year. And the likelihood of being able to save 2.5% is somewhat unlikely. So it just, from the general fund, it would be difficult. We'd have to cut something.
And design services and planning, what kind of money are we talking about when we're thinking about a new public safety facility? Just for the planning process and the design process?
I don't have that number.
Do you have any guess?
With me. It would be, trying to see, I just don't want to guess that number because I don't want to be wrong about that, and I don't have that with me. But typically, a bond measure would have the money in it to do all of that expenditure, rather than trying to find the money up front in the general fund and then going out for a bond. That isn't typically the way that happens.
Right, but the task force said, come back and tell us, or there were people on the task force saying, come back and tell us where that would come from. And so, I mean, you don't need to convince me that we're not going to find the money. But I just think this is an excellent presentation to kind of take to them at our next meeting and sort of lay this out.
Right. I think there's always some view that somehow we could just find the money.
I know.
But really, if there was any money to be found, we would have found it and allocated it by now rather than cutting something else. So we would have to make some cuts in services or, vehicle replacement, which has its own risk if we don't replace vehicles when we need to. We already have that on a pretty long time horizon. We have, in addition, I'll tell you, to what we're anticipating for service needs in this financial forecast, we are not addressing our general fund facility needs. I went through the Senior Center 50 Plus about a week ago. The chairs are starting to wear out. The carpet needs to be replaced. Some of the flooring needs to be replaced. Some of the rooms need to be repurposed for the way people want to use these centers now, and we don't have funds to do that. If we don't do a bond measure that's going to replace the roof of the library, that's about a $2 million expense. We don't have that money in this budget or in this forecast. So you can see the condition of the carpeting and the furniture in this room. We have boilers that go out, we have leaks that start, and we really do struggle with being able to find the funds just to do basic maintenance and repair of general fund facilities. So we're not even beginning to address those issues right now with this general fund budget. So doing a new facility does require a bond measure that can help us pay those costs and do potentially the seismic upgrades for this building. That would have to be done on the roof in the library, so that's the right time to do that replacement of the roof. So it's going to take, just as our streets and bridges bond needs for capital expenditures for streets and bridges, we're going to need that same kind of thing for some of our facility needs.
I think so. And let's not forget the city shops.
The city shops are in great need. We do have a little money in next year's budget recommendation to do at least some initial planning so that we'll know whenever the time comes, this is what we'd want to do and about how much it would cost.
That'll be good.
So, but that is a huge need.
I know it is. I know it is. Okay. So, thank you.
You're welcome. Yes?
I'm under the impression that police facilities, at this day and age, they have off-the-shelf designs. So you could just go to a...
No, we would need to use, police departments operate differently in different cities. And so, based on what your demographics are, how large your city is, what kind of services you provide. So really the best thing to do is hire an architect who is an expert at designing police facilities, working with our police department, so that you have things located in the right place in the building so the flow of work through the building is efficient and effective, because you need a different flow for detectives than you need for police officers who are coming in, getting their equipment, having a briefing, and going back out on the street. So I would not recommend using, and I don't even know if there are any, just off-the-shelf police facility.
Well, if they have an architect that specializes in that industry, then
they
have
have
like rolls
certainly
of blueprints.
They certainly have expertise, and they've done other facilities before, so they're not starting just completely from scratch. But it would be something that we'd have an architect work on. Mr. Fernandez?
It's Peter Fernandez, Public Works Director. There's no such thing as an off-the-shelf design, for any of our infrastructure. Everything is designed for the spot. So even if you knew that the building was going to be 2 floors, that there were going to be so many offices and stuff, you still have to design it for wherever you're going to site it. So there's no off-the-shelf site. So and then for the mayor, that kind of is a full set of design plans. So not just some sketch planning. 8 to 12% of the construction cost. So whatever, just as a rule of thumb, 10% to make the math easy.
Good. So about
So
8
whatever
to
you're
10
talking
million.
about, that's the construction cost, 10% of that would be to produce a full set of design plans.
Okay. Well, that's helpful, because then we can say back to the task force, you know, this is what it would, if the building were this size, this is what it would cost, and where would you find that in the general fund?
Right.
I don't think you would.
So there's some level of, you can get into the debate of, well, but we only want a sketch, and what can you do for $10,000? I mean, so there's all of that stuff, but when you get to the full set, when you get to something you can really sink your teeth into and know what it's going to cost and know what all the issues are, that's the kind of money you're
So
talking about.
10%, that's good to know, thanks.
Yes. And when we report back to the Blue Ribbon Task Force, we'll have our project engineer provide that information to us. I just
yeah.
don't want to say what
No,
it is.
I know
They
you
don't
don't.
let me do engineering. Smart, very wisely. Yes.
Quick comment. Just wanted to note in the back of our packet here is many of the graphs, charts that Tim had put together this
Yes.
evening. If you want to review some of that, went by us pretty quickly.
Yes.
And there's actually some useful information. And for the public who might be watching this, the availability of this information, this packet, is on the website.
It is on the website.
Where would I find it on the website?
You would find it under What's New?
It's actually going to.
Could you come to the podium?
Excuse me, I'm sorry. I was using the home microphone. It will be posted tomorrow morning, and we'll post it under What's New. We'll post the forecast under What's New, and then we'll also include Dr. Dewey's presentation. I would hazard that it's going to be a little difficult with his presentation without his explanation, but, you know, we'll put it out there for folks to review.
Okay, thank you.
Are there any other discussion items or questions for City Manager Norris? Nope. Thank you very much.
Thank you.
All right, next order of business is the election of officers for this year's Budget Committee. I'd like to make a comment first. I've been reminiscing about the work we do here this week, and I came across a really neat quote that I wanted to share. This is by Secretary of the U.S. Treasury, and he said, "The budget is not just a collection of numbers, but an expression of our values and aspirations." And I thought that was really cool. And I wanted to share that because we may not get the highest Nielsen ratings on CCTV, but I think the work we do is important as we work towards a peaceful and prosperous community. So I just wanted to preface that as we elect our new officers. I also wanted to thank Vice Chair Bednars and Secretary Berger for their service this last year. And I want to say it's been an honor to serve you guys, serve with you. Thank you for bearing with me as I stumble through substitute motions, and I got motion sickness a couple times. A lot of those. So, but I'm okay now. Thank you. Thank you. I'm okay. So the first officer is the chairperson, and at this point I would entertain a motion for nomination of our next chairperson. Member Nanke.
Thank you, Mr. Chair. I would move Member Dickey, since it's time to maneuver back into a counselor into the position.
Thank you. Do we have? So motion for nomination of Member Dickey by Member Nanke and seconded by Member Bednars. Are there any other nominations or discussion? Member Berger.
Sorry, I'm a little under the weather today. So I'm going to ask Member Nanke to explain to the new members our tradition of switching between counselors and members.
I can do that with the permission of the chair.
Please.
Typically, we've always switched back and forth each year between a counselor and a citizen budget committee member to chair the committee. At times, we've strayed away from that. I think there was a couple of years that we had citizen budget committee members back to back. Nice to kind of have that alternation. That's a cool word. Just for the sake of those
there's some people who would care to be chair. There's some people who would not. I think it's valuable for both the councilors and the Citizen Budget Committee members that are interested in building that skill. I mean, we spend a lot of our time here, and it's very valuable to learn those elements of running an effective meeting. You learn a little bit about yourself, as well as some skills that'll serve you well for many, many years to come.
Thank you.
And looking at history from, and I thought Councilor Dickey had already served as chair 1 year, and apparently not. So,
any other comments? Member Dickey, we're about to vote. Would you accept if we voted?
Yes.
Right. Just to make sure we don't force you into something you don't want.
I don't know if she has it.
Okay, so all in favor of nominating Member Dickey as chairperson for this year indicate by saying aye.
Aye.
All opposed say nay. Motion passes.
There you go.
Congratulations. So, Member Dickey, would you like to assume the throne right away, or would you like to wait till next meeting? Awesome. Congratulations.
That's actually that's the wrong term.
Yeah, it's approved. That's what. Right.
Congratulations. Thank you.
Thank you, Member Call-White, and you make it look so easy, so I'm sure that we'll follow your lead. Okay, so next item of business is to choose a vice chairperson, so I will entertain a motion for nomination for vice chair. Member Nanke.
I would move Member Berger to the position of vice chair.
Second.
Second, I didn't catch who second. Second by Member Bailey. Is there any discussion? Oh, Kelly.
No.
Sorry.
Was it? No, it was Bailey.
Or three different people.
I thought of your one thing.
I tried second.
All right, is there any discussion? Okay, we'll go ahead and vote. All those in favor of nominating Member Berger for the position of vice chairperson signify by saying aye.
Aye.
Any opposed? Motion carries.
So,
yes.
question. You said all in favor of nominating Member Berger versus actually electing?
I apologize. The motion was to elect Member Berger as
I thought that's
vice
what we
chair.
were
I
doing,
apologize.
but
So.
I wanted to double check.
All right, so now I will entertain a motion for nomination for electing a secretary.
Who's secretary now? This is how bad my memory is.
Member
Oh,
Berger.
all right, there we go. Does it say that on here? Okay.
Yes, Member Benars.
I just had a curiosity, so what does the secretary do? I understand what a vice chair might do, but
If both the chair and the vice chair are absent, the secretary would run the meeting.
There you go.
Okay, Member Berger.
Not a whole lot, judging from what I did. And actually, I was reading the bylaws, and it actually, if the vice chair isn't here, then you elect someone else for that meeting to run it. So it isn't even third in the chair.
Probably look at the rules.
I don't know. I would recommend to anyone who wants it to to take it.
It looks good on your resume, so. Any nominations for secretary? Member Nanke.
Why, thank you. I would nominate Member Bednarz to maneuver crossways
There you go.
for said position.
All right, motion by Member Nanke, second by Member McCoy. Is there any discussion? All right, all those in favor of electing Member Benars as secretary of the Budget Committee signify by saying aye.
Aye.
Aye. Any opposed? Motion carries.
Oh, that was a pretty wimpy tap.
I know, I gotta learn how to.
Yeah, don't be afraid of
Some
it.
practice,
Just give it a
some
good
practice.
whack. Give it a good whack. Oh, okay.
All right, so now we have time for public testimony for future budget issues by members of the public, but tonight we have no one signed up. Are there any members of the public here who wanted to address the Budget Committee tonight? Okay, so we are now on to other business, and I see nothing else on the desk, so I assume we have no other business for tonight?
That's right.
Okay. All right, seeing that there's no other business, we are adjourned.
Thank you. Good job. You'll learn to give it a good whack.
I would just like to thank Member Callaway again for the wonderful job he did as chair for the last year.
Good job, everybody.